Hi there, this is Jeff here. I thought I'd share with you a copy of a presentation I give when I make talks at different schools and colleges around the UK. It's about the UK economy, prospects and challenges as we head into the summer of 2024. And I think it might be useful for those of you preparing for your macroeconomic papers this year. Context matters. I think always having that sense of context is useful for evaluation. And this chart, I think, provides a little bit of it in the sense that the balance of power in the world economy is changing. The share of world GDP adjusted for PPP taken by emerging market and developing countries, including the likes of China, India, Brazil, and so on and so forth, is nudging towards 60%, whereas advanced countries, including the UK, USA, Japan and Germany, have only just over 41% of world GDP. Sub-Saharan Africa, the whole of Sub-Saharan Africa, accounts for only 3% of world national output. And you can see here the steady but persistent decline in the G7 percentage share of world GDP from 2000 to 2023, again adjusted for PPP. So from about 44%, that's now down closer to 30% of world output. The UK, of course, has left the European Union, Brexit in 2020. The share of our total trade, in terms of exports with the European Union, continues to fall. It's been declining before Brexit. Back in 1999, it was 54%. It was 54% in 2006. It's now down to 42%. So any question on Brexit or trade patterns, that could be useful data to have to hand. So where are we in terms of the UK economy? Well, we are emerging from a shallow recession, and hopefully 2024 will be a better year, but don't expect rapid growth. This chart shows the index of GDP since 2007. Obviously shows the global financial crisis in 2008, 2009, and then the impact of the pandemic on the UK economy. Since then, growth has essentially flatlined. And in fact, in 2023, GDP increased by only 0.5%, one of the slowest growth rates amongst leading countries. And because population has grown, per capita GDP, that's GDP divided by population, has fallen. Now, this takes us up to the end of 2023, and it shows that in 7 consecutive quarters, per capita income either fell or didn't change. In other words, there has been quite a big fall in GDP per head. Indeed, if you take taxes into account, real disposable income per head has declined quite sharply in the last few years. Probably it's now lower than it was in 2019. Big story, of course, I'm sure you'll know, has been the big rise in inflation, which peaked at 11.1% in October of 2022. This is CPI inflation here, and of course blew the inflation target out of the water. Many of the causes of inflation were external in origin, including big rises in global food and energy prices. Inflation now falling, so disinflation. By the time you take the exam, inflation will be about 3.2%. It may well fall back to target in the next few months, depending on what happens to energy prices. There's the inflation target, and you can see that it's very rare for inflation to be at target. Of course, that's set as a guide for monetary policy. But inflation is falling, but of course the cost of living still rising. It's rising less quickly. This is an interesting chart. This is a chart from a survey from the ONS. It's the percentage of people who would be unable to pay an unexpected bill of £850 or more. Perhaps, your car hits some potholes or requires some repairs, or there's an unexpected energy bill higher than you thought it was going to be. And it's worth knowing that around 30%, just under 1 in 3 households, would be unable to pay an unexpected bill. Household savings in the UK are pretty low, and this, of course, makes some households vulnerable to having to borrow money from expensive unsecured creditors. Credit card debt continues to grow. This is the monthly credit card debt in the UK. Again, Bank of England provides the source. Back in 1993, there was about £10 billion of monthly credit card debt. It's now up to £70 billion. It fell during the pandemic. People were spending less, but it's climbing again quite quickly. And the average interest rate on credit cards is 25%. In other words, 5 times the base rate of interest. And I think there's also a big issue if you get a question on household spending and living standards about unsecured debts. So this is average personal unsecured debt in 2022 by type. £8,000 for personal loan, £6,500 credit card. Big debts on catalogues, overdrafts, payday loans and store cards. So for those people affected, the level of unsecured debt can be a big issue. One of the things I look at is car finance. Take a look at this chart. Again, it takes us up to the end of sort of 2022, basically. These are the number of cars bought on finance by consumers and businesses. And you can see that there was a surge in the number of people buying used cars in 2022, up to over 1.5 million. Businesses actually bought fewer new cars and bought more used cars. Many of these cars are bought on finance, unsecured debt, and when interest rates go up, it's a big deal. Working poverty, fuel poverty, food poverty. So this is the number of people who use food banks in the UK. Data from the Trussell Trust, which is Britain's largest network of food banks, and just under 3 million people use food banks in 2022-23. I think the figure's just been released for the last year, and it's even higher. So the big debate, I suppose, in the UK has been the inflation interest rate discussion. The Bank of England, as you can see here, was starting to raise interest rates in the spring of 2022. They went up 14 times, I think, to 5.25%, which is where they are as I speak in May 2024. Now, with inflation falling, the issue is whether the Bank of England should now be starting to cut interest rates to nudge them lower, below 5% perhaps. Some people are suggesting the Bank of England was a little bit late to start raising interest rates, and it may also be a bit late to start cutting them. Is the Bank of England behind the curve when it comes to monetary policy? One of the consequences of interest rates going up has been a surge in mortgage rates. Now, that's not just the fault of the Bank of England. There was a slightly chaotic budget in September 2022 by Kwasi Kwarteng under the short-lived Truss government, which caused interest rates to surge. But you can see here that mortgage interest rates, having fallen for many, many years, whether it's a fixed rate or a variable rate, they are now much higher. A lot of people saying that we now need to adjust to a situation where the cost of a mortgage, a home loan, is 4% or more for the foreseeable future, certainly in the next year or two. Most mortgages are taken out on fixed interest rates. So the question is, what can you fix the rate at? I've just taken out a variable interest rate where the rate moves with the base rate plus a small percentage. Now, interestingly, there are still well over 1 million people in the UK who still have to renegotiate their mortgage in 2024. And they might have taken out a mortgage, let's say, in 2019 with interest rates at 2.5%. And now they have to adjust to 4.5%, 5% interest rates. That will be a big hit on their effective disposable incomes. The labour market is quite interesting. So unemployment is now starting to rise a little bit, 4.2% as I speak. And there's the path of inflation, of unemployment since 2006. Obviously, it surged during the global financial crisis, then fell encouragingly down towards 4% by 2019. It went up during the pandemic, but of course the furlough scheme helped mitigate that. So we've had unemployment at or around 4% for some time. But as I always say to my students, look beneath the data, look beneath the surface. So whilst unemployment in the UK is 4.25%, 4.2%, there are big regional variations. And as you can see, actually, the northeast, which is my kind of part of the country, the northeast actually has lower unemployment than the southeast and lower unemployment than London, which some students find slightly perplexing. But have a look at the other data on the right-hand side, inactivity. Now, this, I think, is a big issue. So inactivity represents people of working age who are not in work, not looking for work, not available for work. And the UK rate is 22.2%. In other words, over 1/5, nearly a quarter of people of working age in this country are economically inactive. And in the northeast, unemployment is low, 3.6%, but inactivity is very high, 26.9%. I think only Wales has a higher rate than that. So there is clearly a big issue here. People are out of work. not necessarily actively looking for or available for work. This is one of the that's not really a hidden issue, it's one of the fundamental structural issues facing the UK. Many employers still complain of skills shortages, SSVs, skills shortage vacancies. So as of 2022, 10% of employers had a skills shortage vacancy, and skilled vacancies were over 1/3 of all vacancies in the UK. We have just under 1 million job vacancies left unfilled. Now this is the key chart, I think. This is the inactivity rate. We made some progress in cutting it, but it's now starting to rise again. As of the end of 2023, 9.25 million people of working age were economically inactive. And a lot of that is due to the rise in long-term sickness, which was starting to rise before the pandemic, but has clearly accelerated since. So there's been an increase of over 800,000 in the number of long-term people who are inactive in the labour market, who are long-term sick. They have one or more chronic health issues. Migration, never far from the surface when it comes to both the economic and political debate. Just wanted to look at this chart, which shows immigration and emigration. And of course, in 2021-22 into 23, we've had a big surge in immigration, over 1 million people. This is on a moving average a year ending, so it's an annual figure. The net migration figure is the difference between the blue and the black line there. So net migration of over 600,000. Now, some of this is due to temporary factors, we hope. The impact of Afghanistan, refugees, Hong Kong, Ukraine, and also due to an increase in the number of students and sometimes their families returning back to the UK after lockdown. But there also has been a significant increase in the number of work visas. So, of course, the UK, having left the European Union, has now brought in its own migration policies, and the number of work visas in the UK has gone up from 114,000 in 2020, which is obviously depressed by the pandemic, to nearly 500,000 in 2023. And I think that's a reflection of the skills shortage vacancies that we mentioned a few minutes ago, that the number of work visas is seen as a short-term palliative, short-term measure designed to address those skilled job shortages. On the fiscal side, the government obviously continues to borrow money, for sure. They borrowed £121 billion in the last financial year, about 4% of GDP. Well, that's down from a budget deficit in excess of 13% during the pandemic year. Of course, the furlough scheme helped account for that. So the government's on course at the moment for the deficit to continue falling, albeit slowly, towards 3.5% of GDP by 2028. But of course, the national debt continues to grow. As a share of GDP, it's climbed quite sharply. Go back 15, 16 years, in 2007, national debt was below 40% of GDP. Then the global financial crisis hit, the surge in the national debt towards 80% of GDP. Then it stabilised. Then the pandemic hits, the national debt rises above 1995 towards 100% of GDP. Depends if you include the Bank of England's debt. This data doesn't. Now, the forecast is that national debt will start falling in the next few years. But for that to happen, the government needs to bring down the budget deficit, or the economy needs to grow more quickly. And what is true is that the cost to the government of borrowing money has gone up. So this is the interest rate on government debt if you want to borrow for 10 years or if you want to borrow for 20 years. And you can see that, again, the transition is now to an environment of much higher interest rates. So these are interest rates that you won't have seen if you're an A-level student, probably in your sort of economic lifetime, if you like, your awareness of the economy. So we've moved from very low interest rates, in nominal terms perhaps 1-2%, in real terms perhaps 0%, towards an interest rate now of 4-4.5%. So the government is having to spend more on interest on the debt that it has and the new debt that it issues. And I think last year the UK government spent just over £2 billion a week in debt interest. That clearly has an opportunity cost. Debt is rising, taxes are rising. If you take all the taxes together, both direct taxes such as income tax, corporation tax, national insurance, which has come down, indirect taxes, VAT, all those kind of duties and things, the total burden of taxation as a share of GDP is now above 40%, and it's the highest is forecast scheduled to be the highest it's been for over 70 years. Now, part of this increase in the tax burden is the freezing of tax allowances. So the UK government's frozen the income tax allowance, I think at £12,570 for 5 years. Well, what does that mean? Well, it means that as you earn more and spend more, but particularly as you earn more, you pay more in tax. So if you get a pay rise, you might suddenly be paying tax at 20%, whereas you weren't before. Or you might suddenly be paying tax at 40%, whereas previously it was 20%. So fiscal drag arising from the freezing of tax allowances is bringing in tens of billions of pounds of extra revenue for the government. Good news for them, but it means the tax burden is rising. Corporation tax has gone up from 19 to 25% for large companies. So the government is taxing a lot more than it did 10, 15 years ago. And then inequality, relative poverty. Again, we have to look beneath the surface here. We are a rich country. We are one of the largest countries in the world, albeit we only account for 2% of world GDP. But what about relative poverty? One measure is the number of individuals in relative low income. That's an income below 60% of median income. And if you can see here, before housing costs, around 11 million people in relative poverty. After housing costs, close on 14.5 million. And that figure has gone up. It's gone up from about 12 million in 2004 to 14.5 million now, including child poverty. 4.5 million children live in poor households. Now, the after housing cost one I think is quite relevant here because the cost of housing, including rent in particular, has been climbing very steeply. So that is a major factor driving relative poverty higher. But it comes more or less in the middle when it comes to child poverty. Percentage of children in poverty. Costa Rica actually comes highest. Turkey, Chile and Spain. USA, the worst 20%. And then all the way down to the UK, we're at about 14% of children in relative poverty. And then obviously Denmark, Finland. You'd expect Norway, Denmark and Finland to have relatively low child poverty, and indeed they do. There we go, a whistle-stop tour. Hopefully you got some useful context, some useful application as you head into your macro papers. Please keep revising hard, keep preparing for your papers. You'll do well if you sprinkle a little application. If it's a daily response question, the application is in the extracts and the charts and the tables. If it's an essay question, just impress the examiners with some salient statistics to make your essay come alive. So stay positive, stay curious, and hopefully see you sometime soon.